I guess we have to start getting used to these Mondays now where the market actually goes down. For a while there, it seemed like every single day, well, every single Monday it did go up for a very long. In fact, I think it ended up being a pretty historical streak, maybe the longest ever, if I remember correctly. Um, but now we're getting like multiple down Mondays in a row, and we'll put this into context. It wasn't that big of a down day, and we'll take a look at, especially in light of the rally that we've had over the past 5 weeks, which in and of itself is pretty historical too. And as I've shown you before, one of your bigger 5 week rallies that we've had, like literally maybe like top 20 of all time 5 week rallies. So we're going to put that in the context and take a look at what's driving the price action now coming out of that stretch as some of these oscillators and different indicators are starting to reverse a little bit. So we'll take a look at that and see kind of what our expectations are going into the rest of this week. A very important week, I believe, from a technical perspective, considering the factors we've just been talking about, as well as the jobs report and things that are coming out that also can impact an upcoming inflation report and FOMC meeting that will be coming up soon as well. So big couple of weeks from a macro perspective, but especially from a technical perspective. So we'll take a look at that, our trade ideas as well, stock, a big stock, has been a bellwether tech stock, very traditional name, but it's been kind of showing a very interesting pattern, different from what we're seeing in the broader market. So we'll talk about that and talk about how to trade that. So let's go ahead and get started. Today is Monday, December the 4th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching this on our blog, check out some of these other things over here on the right-hand side, including a Market Outlook live video. Come down here to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this tab. This thumbs up icon takes you to this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. Is what we always ask. It's a really big deal for us. Our goal is to get to 100, so we're getting closer. So those who are doing this day after day, thank you very much. Those who aren't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, a down day today, which is, again, now it's not uncommon for a Monday to be a down day. We've had like quite a few Mondays. This was a really good Monday, but then you look at like, I believe it was right here. Yeah, this was a Monday before that, kind of like this one, current one. This was a Monday right there, and it was slightly higher. This was a Monday here, so you can kind of get an idea that we've there's been quite a few Mondays that weren't so bullish. Right here was another Monday. So we had 1, 2, 3 out of 4 with a small gain in 5, so 3 out of 5, and then coming down into where we were Monday every day. There's a Monday that was a down day there, so 4 out of about 6 or 7 after like 17, 16 in a row. So it's been a different, but again, you notice every single one of these down days were even kind of relatively bullish, and in fact that we rallied. We rallied after the open, right? We finished higher than the open there, finished higher than the open there, finished higher than the open there. So it kind of puts that bearishness into context. The near-term line is rising, of course, it was rising, but it did not get into the reversal zone and has already fallen down a little bit. So we have what would be a bearish near-term peak here. The momentum line, of course, falling because of the down day. It was at extreme highs on Friday. We were really, really close to a cluster on Friday, of course. But what is interesting to watch, because remember, we had a 20-day near-term run, which is well beyond the 7 to 12-day window, which is typical for bullish trends. And we didn't we didn't retrace hardly anything at all. And we talked about that, right? We talked about, okay, well then that means the next near-term rally will probably be very shallow, kind of like you think about, like you take a big inhale and then you let out a very shallow exhale, and then you just try to inhale again, and it's kind of hard to take a good deep inhale again, because you didn't exhale very much. So it ends up being kind of like, shallow inhale, shallow exhale, shallow inhales until you have to fully exhale what you had, when you started this off with such a deep inhale. And so and that's how the markets work too. And right now we're in kind of that mode of getting, a shallow inhale again, as we are well above the moving average, still easily above 2.5%, in this upper quartile, so to speak. So still pretty bullish, and so that's not, that hasn't changed anything. The NASDAQ, you'll notice here, was a little bit more bearish, so we finished well off the lows of the day. The near-term line did not ever get into bullish territory, so it's actually been down here this entire time, just never really getting deep, very deep there. And then your Russell 2000 did not finish lower at all. It actually finished higher. Remember, the S&P is like way up here, getting, well above the 78th percentile, getting a lot closer to these highs. The Russell is not, and the Russell ended up finishing not only with a cluster. We barely avoided a cluster on Friday. Today we did get a cluster. So not only did we get a cluster, we are in the 93rd percentile of this PPO over the past year. You can see it was higher. You can kind of see where it was higher there back in August or February of this year, and that's where we had a cluster over there too. But we got up to these extreme levels and then faltered, and we'll see. If we are kind of getting a blowout top, a catch-up trade that ends up being a blowout top. Again, we've seen this before, right? We saw that before there, and then it faltered pretty badly, and we'll see if that ends up happening again here, in this case, with a cluster, all the way up to that 38% Fibonacci retracement, goes all the way back to the move off of the COVID low. So we're back up to that resistance that we've been kind of flirting between that, in that area, above it a little bit and down below it, down to the 50%. And this was our bigger drop below the 50% that we had, and you can see all the clusters have all ended up kind of being peaks here on the Russell, especially when they were so far above the moving average. And again, that has the potential for being that way again. You are getting the early stages of a transition candle. It is a lower close and obviously a lower high as well. The PPO is still rising, though the MACD is below, or the Hawking-Ashby differential, is below its moving average. It's still positive, but it is below its moving average there, sign of weakness. Looking at the three green arrow chart, you can see again we are in convergence mode on the MACD, or on the S&P and the NASDAQ. We are not there yet on the Russell or the Diamonds, as the MACD is actually rising on both those indexes. If you look at the S&P here, we're flirting with the 8-day moving average as the MACD has crossed below its moving average. Again, like I said, IWM, which has been catching up, see that we did get a higher 52-week close, and we did get a higher high there as well. That's not the case in IWM, and so there's a big catch-up trade. We just blew right through the 200-day moving average on Friday, and now today up at the top of the value area again. Very, very big move, big volume, big directional movement index for the Russell 2000. As you can see, almost up above 30 again. This is about the highest that we've gotten this year on the positive indicator. It's also about the lowest we've gotten here on the negative indicator. So again, the last two times that we've reached these peaks with these clusters were also times that we had this kind of DMI pattern. So it kind of gives you an idea of just how extreme it is. Of course, the CCI is dropping back down, still above zero. The RSI is dropping back below 70, though still above 60. So they're still at bullish levels. They haven't changed that yet. You look at the Ichimoku cloud, still above the green line, which when you have a mature trend going, you're watching for that green line to get below that. You can see we broke way up through the cloud. We have a huge rate of change right now on the Russell 2000. That's see how far it is. This is obviously today. Tomorrow, it's going to be even further up. And now you do have really close to a mature trend going there on the Russell 2000 as well, and easily a green crossover there on the cloud. Looking at the Bollinger Bands, you can see we are towards the upper quartile of the bandwidth as the momentum has been declining, still above the Keltner channels there. IWM, remember, has been so behind. It's up against the last 2 days, up against the upper band, and way up above. This is the last 2 days of the first days that we've been above the Keltners, and we are now way above the Keltners, like way above them, and pushing, like I said, up against that Bollinger Band with a renewed strength. And we've seen that before too, right? Where looks like you're starting to turn bearish, then you get this renewed move to the upside. In this case, that February 2nd peak, and then we falter, right? So. And same thing over here too. You look like you were going bearish. We got a renewed move to the upside that broke above the Keltner channel, and then we faltered. And so, here we go, getting some weakness, renewed strength above the Keltner channel. Most likely, if we follow that pattern, obviously there'd be some faltering going on there. If you look at today's intraday move, you can see the gap down, and we ended up closing at the top, at the bottom of that gap, as flirting with filling in that gap there. And we'll see right now we're a little bit below it now in the after hours, and we'll see if we end up filling in. That was a pretty decent sized gap. It was more than one standard deviation move to the downside. We only finished a 0.5% down, so you wouldn't necessarily call it a runaway gap, though. Again, it was a big enough gap to warrant being a runaway gap, and we still haven't filled it in despite the fact that we've rallied a couple times throughout the day today. So it still has a pretty decent chance of being just a common gap, which means it gets filled in sooner rather than later. Today's volume and range, right below average on the volume you see there, and a little bit above average on the range. So the ATR is actually starting to move up slightly. You can see it's back above. Remember, had gotten below 4, which is kind of an extreme level. It's gotten back above 4, so we're kind of working our way back towards 1, even with volume dropping off like a rock. That's kind of a sign of volatility when you start to see a little bit higher levels of range going forward. You can see also the VIX had jumped up higher, though it did finish the day down just barely above 13, easily below 85%. That negative correlation with the VVIX is starting to slowly come back up, though it's still negative. Again, that's setting us up for a volatility move, that gap there. Now, today's big move was actually in gold. You can see gold had been relatively bullish. It's been kind of funny to see so many people fawning over that move in gold. I'll show you here in just a second. As bullish as we had been, look at big move. That was our big move to the downside. IWM, of course, was our big mover to the upside. The strength in the dollar was the big reason why, as well as the increase in yields. But that was your biggest reason why stocks were as bullish as they were. If we were to take a look at the dollar index here, it had been coming down towards some support, hit that 62% retracement, has been bouncing back up. It's back above its 8-day moving average. MACD is above its moving average. Stochastic is rising out of bearish territory. Still hasn't broken the 17, but you can see the close above the high of the low day, and the things are turning around there. The 10-year yield up a little bit, but not very much, as we've been converging there. The opposite, of course, would be TLT, and TLT is still pretty bullish. In fact, its 30-day has crossed the 50-day. Usually when the 30 crosses the 50, you get like, for example, right here, you get a little bit of a retest before things like, here's another example over here where it crossed above 50, and you got a little bit of a retest right after that cross. That happens a lot, and these two lines are kind of close to each other. So again, suggesting that we might be retesting here, which would be bullish for yields. But when you take a look at gold and how it's been performing here, relative, like first of all, gold, and there's been a lot of chat about gold making new highs, right? Or getting really close to these highs from 2022 and then again in 2020. Big move up, and this is just the ETF that tracks gold. But look at gold relative to, so you remember those highs in mid-20 and early 2022. Look at gold relative to the S&P 500. right, with the Magnificent Seven. So there's that peak in mid 20, way up here, and then there is the peak in early 2022. So we're nowhere near right now that peak in early 22, much less the peak from 20. Even though gold on an absolute basis as well is approaching both of those peaks. And so it kind of gives you an idea that, okay, gold might be doing pretty well, but again, the alternative equities has still been a better, no matter how good gold has been, it's been better to not put your money in gold and put your money in equities, and that continues to be the case here. If you take a look at the breadth, you can see a pretty decent breadth to finish the week last week, getting above 336 on the number of stocks and getting well above this 400 out of 500. So that would be 80% of the S&P 500, and you're looking at about another 20 stocks there. So you're pretty close to 90%. So you're about at 85% right now. Number of stocks above their 50-day moving average. A strong run. It's pushed this ratio chart. Kept it right around this 0.80 mark. This big move to the downside, and of course, obviously, breadth is going to be a big deal. When you look at the new highs and new lows, they had exploded above the 100 mark. Got up to 220 again today. That's a good sign for breadth there. And you look at the McClellan oscillator here, which is something on our platform that we use to kind of measure the breadth. Above, it's still in the 60s. In fact, you're almost above 500 on there. Again, you got above 500 on that August peak. You didn't quite get there on the March peak from last year, but you did get above it on the August, and of course got way above it there in January, and came close to it in November. But we've seen it get above. We've seen this kind of move peak in August on such a strong rally, right? Of course, you're going to have moves to higher highs and higher lows. But we're talking about in a kind of this correction mode where you have such a strong breadth move. Push you up. It seems to be what we're getting again. One more index I wanted to show over here was that skew index, because it has been flirting with breaking below its moving average. Moving average now is easily above 140, which is again a very high level. And now the skew's at 144. Kind of keep an eye on that. The skew's already at a pretty extreme level to the upside in the 140s. So there's not a whole lot of trending to go like it did over here to get up to these strong peaks, which is typically bullish for the index, as you can see there. So, but since we're already so bullish, the idea of a trend is probably a little bit far-fetched, and more likely that that we're going to be flirting with breaking. When you get break below, the skew breaks below its moving average, that's kind of coincident with there being more of a bearish move going on. Let's take a look at how the sectors performed today. So you saw, again, yields and commodities. But if you take a look at the sector comparison chart and just look at today, you can see the big winners over the past 3 months: technology, communication services, and financials there. We are in December, so let's go to December here. You can see real estate was a big winner today. Industrials was a big winner. Staples, healthcare, financials. That's not your picture of strength. And of course, in fact, your biggest losers today were technology and communication services. In fact, when you look at the ratio chart of the Qs IWM, we had kind of broken down on Friday. Well, no doubt about it today, we definitely confirmed that breakdown. And you can see we are well below. Now, we're almost below 2, we're well below the 50-day moving average. That MACD is really bearish, the most bearish it's been in a while. That PPO is rolling over. The CCI, extremely low levels, bigger levels than we've seen since way over here. And then, of course, the RSI dropping below 40 now, easily below 40. Again, we haven't seen that in a while. As the correlation between this ratio, as it's breaking down, and the S&P is turning positive, which means, again, that as this breaks down, you wouldn't expect that to be a bullish thing for the stock markets unless it's some kind of like reopening trade like we had there. Otherwise, when the ratio has dropped, it's actually been a lot more bearish as the correlation has been pretty positive. In fact, if you were to change that correlation to like a weekly chart so we can see it a little bit better. You can see the correlation has been pretty positive for most of this period as we've transitioned to kind of this inflationary period, but very strong positive correlation, breaking below the 17-week moving average there, and the intermediate line already breaking down, the MACD breaking down, and the long-term PPO looks like it's close to getting to that level as the things flip to bearish on the ADX and the CCI. Let's take a quick look at the 12 grid here really quick for the sectors. And you notice dark green shading, green line across the board, way above the moving averages pretty much across the board, especially like in utilities here lately. But cluster there on industrials, close to having clusters and everything else. Intermediate lines in the 90s across the board for the most part, except for energy. And energy continues to be a big decliner, and it's actually been bullish for the markets to have crude oil on a decline, or commodities in general, but one of the biggest components of that commodity index is crude oil. Crude oil, you can see, is kind of on the verge or kind of at a low point right around 73 and on the verge of either really breaking down here or, again, finding support in this area where we're currently at. All right, so for our trade idea of the day, I wanted to take a look at Intel. Intel, you can see, decline for a second day in a row and continuing to move slightly lower. The short-term sentiment moving towards into bearish territory towards the lower reversal zone. So you can see the intermediate line dipping there. If you take a look at its weekly chart, you'll notice that it's not bearish, but it's starting to form a little. It's very high on the PPO, 100th percentile in the past 3 years? Yeah, 3 years. And it's got a transition candle forming on its weekly chart. Looking at its 3 green arrow chart, you'll see that we did break or at least we were flirting with the 17-day moving average. MACD is plummeting. Stochastics is dropping too, giving a red arrow, obviously well above the moving average, so that you don't have 3 red arrows yet. Looking at some of the other oscillators, you can see the DMI, big reversal in the DMI, well above, like we went from extreme lows on the negative indicator to back above 20, from being above 40 to now flirting with getting back below 30. So not bearish, but not big significant reversal. Below the, still have a mature trend, very strong rate of change, really high rate of change. But remember that is getting below the blue line matters when you don't have a trend, a strong mature trend above 80, above 5 down here. Getting below the green line is what you look for when there's a big gap, because you start to fill in that gap there at the very least. When you look at the RSI and the CCI, they're also breaking down from strongly bullish levels. Not bearish, but not strongly bullish anymore either. And then finally, the Bollinger Band showing the same thing. Still above, at least was above the Keltner channel, now not, and now sitting right at the chart's midpoint with the bandwidth coming off of extreme highs, well above the value area, way above the value area there, and the momentum dropping off on the momentum line as the bands are moving back towards, the bands are so far outside the Keltner channels, which is what this momentum measures, and now we're moving back towards the Keltner channels there. So you can see a pretty significant change in direction. So what I decided to do on this, bear with me 1 second, is to come over here to the January options and to sell a bear call spread. Sell the mid-30s delta, the 44, and then buy the 46 for protection. There's the trade there, position size for a full contract. And again, the idea being, because we're 45 days expiration, the idea is if we can, before 20 days, if we can get to 50% of maximum gain and then take it, then we can use that $1,000 for a full maximum gain somewhere else on another trade. So we're kind of hoping that we don't necessarily need it to fall too much, but if it can fall inside this volume gap down toward these moving averages, then we can get our reward quickly and move on to something else before January, before we're done making January expiration trades. All right, that does it for me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your evening, everybody, and we'll see you all next time.